The stock market has undoubtedly had its ups and downs. However, this time it has gone down drastically. Ever since 2020, the stock market has been struggling to stay up, but come 2022, the stock market has gone down and has also crashed. Companies right now are struggling to retain their positions. Even the strongest of stocks have gone down. But what do we mean by a stock market crash? What is the cause of all this? Today, we will look at what's happening in the stock market and why you should definitely stop buying the stock market. However, before continuing, please subscribe to this channel for future updates. With that out of the way, let's get started. This is definitely the time to stop buying the stock market, even more so because the stock market just keeps crashing. If you invest in the stock market right now, you will only be making losses rather than profits. With the stock market hitting, most of the stock prices are going down. Even the greatest of them all, the S&P 500, has gone down by about 20%. This has made most investors sell their stocks. But wait a minute. What is a stock market crash? A stock market crash can be described as a sudden and dramatic drop in the value of stocks listed on an exchange. Such a drop can be caused by several factors, such as economic or geopolitical events, rumors, or even compounding herd behavior. One thing about this is that it is not really known how long it will last. However, most people always confuse a stock market crash with a market correction, but even so, there are specific thresholds for each. A stock market crash mainly causes stock prices to fall by 20% or even more from their recent high. On the other hand, a market correction causes a drop of about 10% or slightly higher. The most recent stock market crash was in 2020. This was caused by the COVID-19 pandemic that saw all businesses brought to a standstill. There were still those industries that made a profit, such as natural gas, software, and the healthcare industries, but on the other hand, industries like real estate, entertainment, petroleum, and hospitality saw their stock prices rise. We may be experiencing yet another stock market crash, and at this time, it is all rounded. Very few industries are counting profits and gains right now. But now that we know what a stock market crash really is, how does it work? One thing is that a stock market crash can happen at any time. However, it tends to occur during times of economic or political turmoil. One of the worst stock market crashes ever occurred in 1929. It marked the start of the Great Depression. It was caused by several things, like the economy slowing down, people betting too much on stocks, and the Federal Reserve making it harder to get credit. If a crash occurs, it could have a widespread impact on the economy. Some companies may end up going bankrupt or even fold entirely. Investors may also lose their entire net worth overnight, while others may get the chance to salvage the little they can. Others can also sell off their stocks before the prices drop even further. Generally, a stock market crash is not pretty, and it could lead to some significant layoffs and economic strife. Even though stock market crashes are not scheduled, they happen in cycles. This has been referred to as a boom and bust by the investors. The US alone has had some major stock market crashes in its history, with the most notable ones being Black Monday and the dot-com bubble burst in 2000. Financial analysts can somehow predict when the market will start to fall. They look at some of the factors affecting the market, such as its momentum and volume. In addition, whenever there is a sizable economic event or geopolitical tension somewhere, the media always covers it. This can predict further drops in the market and can trigger a mass sell-off. When a stock market crash occurs, it reminds investors that the economic system is still fragile and the importance of diversified investments. When an investor understands how the stock market crash works, he can prepare to avoid or mitigate potential losses in their investment portfolio. It is advised that you should stay calm during a stock market crash and take action to protect your portfolio. Those investors will tell you that a stock market crash is the best time to invest. However, it is risky because there is a possibility that you will catch a falling knife by buying a stock that is still losing. There is no way of preventing or stopping a stock market crash. However, the market could be frozen and reopened when there was high volatility. In the past, a market freeze would allow investors to restructure their portfolios and hedge against some of their losses. However, investors could also be locked into unfavorable positions. In 2022, the stocks had a terrible start. As mentioned previously, stocks such as the S&P 500 have gone down by 20% since the beginning of the year. This has caused great unrest among the investors in big tech as they become more concerned about the economic growth outlook. Some of them are even pulling back from complex parts of the market that are sensitive to inflation and rising interest rates. While the stock market is highly volatile, it is customary in the short term. However, the market weakness in 2022 has the investors even more worried, especially since they can expect a more significant downward movement. But what has caused the market crash that is here in 2022? One of the factors causing it is the high inflation. The US economy is currently going through high levels of inflation. Inflation here means the rate of change in prices of goods and services over time. Over time, the prices gradually rose, which has contributed to stock market volatility. Inflation is mainly measured by the Consumer Price Index, or CPI. The CPI reading in April increased by 8.3% on an annual basis. If inflation were to go on, consumers would be significantly burdened, mainly because prices would rise, but their wages would remain the same. Not only that, but even higher prices for raw materials, inventory transport, and labor can affect corporate balance sheets. Another factor causing the stock market crash is the rise in interest rates. With inflation being a significant economic concern, the Federal Reserve will most likely continue tightening monetary policy to maintain its target of 2% inflation over the long term. To achieve this, they might end up raising interest rates. Even though increasing interest rates do not aim toward beating down the stock market, it adds some pressure to the equity market. With a rise in interest rates, companies tend to cut back on spending, which eventually slows down the economy and the rate of corporate earnings growth. The Russia-Ukraine war has been one of the primary reasons we are experiencing a stock market crash. It has made the stock market highly volatile all over the world. Most countries, especially those in Europe, have been reliant on Russia energy exports, all of which have been disrupted by the war. Russia produces about 10% of the oil that is distributed all over the world. However, many countries have boycotted importing products from Russia because it attacked Ukraine. Eventually, this has led to the inflation of oil prices, which has been a significant burden to businesses worldwide. One effect that is still being felt to date because of the COVID-19 pandemic is supply chain issues. There are still some residential global supply chain challenges that are being felt even though the pandemic has subsided and most operations are back to normal. There is a high demand for goods and services, and it's still growing. However, production is pretty low, and companies have to catch up. If the companies failed to meet the customers' demands, they could be making losses instead of profits. There are unsustainable labor costs all over, and this has caused some companies to count losses. For example, a company like Microsoft has increased its pay to the employees to get them to stay. However, it has doubled its budget by doing this, meaning that it will be recording slower gains. No investor will want to see slow growth rate because their money will increase slowly. Because of this, investors tend to run from the stock. The market is bound to crash if lots of companies do this. A stock market crash is not a good thing, and investors tend to stay off the market for a while not to count losses. If you don't want to count losses, you should also consider staying off the market for a time. What do you think of this video? Let me know in the comment section below. If you enjoyed this video and would like to see more, don't forget to click the like button and subscribe to our channel before you go. As always, thanks for watching.